My name is Trent Rhodes, and I'll be doing my presentation on private placement offering memorandums, due diligence, and the term sheets involved with them. To start off, private placement offering memorandums are a tactic used by privately held businesses in order to attract a specific group of outside investors. This is done because these companies wish to remain private but are in need of financing and looking to increase the rate of growth in their firm. Usually, a company would have an IPO and become a public company and look for investors that way. Uh, An IPO also allows anyone to invest in a company and helps to quickly uh, raise capital through the sale of stock, and the company usually experiences high growth because of it. When a company decides to go the route of a private placement offering, they are mostly doing it because they are in a very large firm and they wish to avoid the burdensome regulatory requirements of an IPO. PPOs also require much less time and money to initiate and still grant the company the advantages of being private. Once the company finds potential investors, they create an offering memorandum. This is a way of the investors to understand the investment. The memorandums are usually put together by an investment banker on behalf of the owners of the business. That banker then acts as a medium and conducts an auction between the different potential investors to generate interest from the buyers. So moving on, an example of a situation where an offering memorandum would be used could be a private equity company that is in a manufacturing space. They want to increase their level of growth without taking on massive debt or being forced to go public. To increase growth, they need to up their output and need to expand by adding another plant. The business owners would then decide to go through an offering memorandum as a means of financing the new expansion. They would have to calculate how much they want to raise and what price per share. The company would then have the offering memorandum drafted up and make sure it is fully compliant with SEC security laws. This document is then distributed among the potential investors that can be handpicked by the company. This is one of the best perks of initiating a PPO opposed to an IPO where anyone could decide to invest. This memorandum that is distributed informs the potential investors about all they need to know in terms of the details of the company. When looking for potential investors, the issuing company would first create a general term sheet that could be distributed to give prospects a brief overview of what the offer will include. Unlike a fully formed offer sheet, this is comprised of bullet point summary laying out material terms and conditions. When engaging in a private placement offering, one of the most important aspects is to ensure that both parties exercise their due diligence before making any final decisions. After the Wall Street crash of 1929, the Securities Act of 1933 was created to protect investors and ensure more transparency in financial statements, so people could make much more informed decisions about their investments. Laws against misinterpretation and fraudulent activities were implemented in this act to try and prevent anything like that from ever happening again. With these new laws in place, investing in companies became much safer and more reliable. On the other hand, companies were also given much more transparency into how they could analyze any potential investors in the company. Many businesses in the past accepted investments from investors that ended up defaulting because of a lack of due diligence. The process of performing due diligence on a company one wants to invest in has many steps and is very thorough. It begins with analyzing the company's total value and market capitalization to see how volatile the stock price might be. Next, they analyze the revenue, profit, and margin trends of the company in the income statement. Third, the investor will look at all competitors of the company along with a broad overview of what the industry is looking like and how they will fit into it. Price to earning ratios, price to sale ratios are analyzed next and compared to its competitors. This could reveal even better investment opportunities that you didn't know about. An analysis of the management structure along with who owns the majority of the shares in the company is done next. This can reveal whether the shares are held mostly by the owners of the company or by investors. When a majority is held by higher-ups in the company, generally is a good thing because they have much more of a vested interest in how the company does. So the balance sheet is analyzed next to show what assets and liabilities this company has along with how much cash they have available on hand. Shares outstanding has to be found as well to see how the company they compare to investors. If they plan on issuing more than a price, it might be very likely, and investors need to be made aware of this. So once long and short-term risks are examined, the investor has completed their due diligence, and if they like what they see, they can go ahead with the investment, knowing they have completed their proper research. So in conclusion, private placement offerings are a great opportunity for companies looking to raise their capital and reach that new level of growth.